Welcome to the deep dive. Today we're taking a close look at a major player in the beauty world, Coty. They just announced their Q4 results and, maybe more importantly, shared their vision for what's next in this incredibly dynamic market. So what do these numbers and plans tell us about the future of beauty and, what does it mean for you? Okay, so Coty Inc., ticker COTY, they just reported their fourth quarter results for fiscal year 2025. This was on August 20th. And looking at the headline numbers, they brought in $1.25 billion in revenue for the quarter that ended in June. Now, that's actually an 8.1% decline compared to last year. And their earnings per share, the EPS, it came in at $-. That's a little worse than the -$0.03 from a year ago.
Yeah, and what's really fascinating here is the market's reaction. It tells us a lot about what investors are really looking at.
Yeah.
Because while that $1.25 billion in revenue, it actually beat the analyst expectation. The Zacks consensus estimate was lower at $1.2 billion, so nice beat there. But their EPS of -5 cents, that significantly missed the street's forecast. They were expecting positive 1 cent.
Wow, that's a big difference.
Huge. We're talking a -600% surprise. And, well, the stock dropped almost 11% immediately after. Yeah. It really underscores that, while that top-line revenue beat is nice, profitability and, crucially, cash flow are often what really move the needle for investors right now. And if we dive into the different parts of their business, Coty's prestige segment, that's their high-end stuff, fragrances, cosmetics. It brought in about $760 million. Now, that was down 5.3% year over year, but again, slightly better than analysts predicted.
Okay.
Their consumer beauty division, home to brands like CoverGirl, Rimmel. Net revenues there, $491.8 million. That was a steeper decline, 12.3% year over year, but still also above the estimates.
So revenue beats across the board, but still declining.
Exactly. But, and this is really key, the profit picture was, well, tougher. Their operating margin, which is basically how much profit they make from sales, it narrowed. Went down to 1.2% from 2.5% last year. And free cash flow. This is the cash the company generates after covering its operating expenses and capital spending. It swung pretty dramatically, went to -$131.8 million. That's a huge shift from a positive $116.7 million last year.
Wow. So they were actually burning cash in the quarter.
Right. And that signals some real short-term pressure on their financial health.
Okay, so on the surface, some mixed signals, right? Revenue beats, but profit misses, and negative cash flow. A clear negative investor reaction. However, Coty CEO Nabi, she opened the earnings call by emphasizing 5 years of consistent performance. She described a transformation into a, quote, much stronger, more focused, and more resilient beauty leader. Sounds like they've been laying some serious groundwork before this quarter. What does that foundation actually look like?
Yeah, that's a really important distinction to make because those 5 years, let's say fiscal 21 to 25, they show some really impressive gains. Gains that kind of set the stage for the challenges they're navigating now. Take prestige fragrance, for example. They grew that at a robust 10% compound annual growth rate.
Okay, so 10% average growth per year.
Exactly, over 5 years, to build a $3.5 billion business. And what's maybe even more impressive, they consistently outperformed global rivals. We're talking L'Oreal, Estee Lauder, Shiseido, LVMH's perfumes and cosmetics in most quarters.
That's huge in that competitive space.
It really is. It's not easy. And then their consumer beauty division, which, had struggled for years, it actually got back to growth, a 2% CAGR. They stabilized distribution, renewed key brands like CoverGirl and Rimmel after years of decline.
Right, I remember those brands seemed to be fading for a while.
They were. So that turnaround was significant. And financially, their Adjusted EBITDA, it's a key measure of core operating profit, it grew by 9% annually, from around $760 million to over $1 billion, $1.8 billion. Margins expanded, too, by almost 2 percentage points to 18.4%.
Solid improvements.
Very solid. And maybe most crucially for their long-term health, they slashed their debt. Their leverage ratio, how much debt they have compared to earnings, fell from about 6.8 times down to around 3.5 times.
That's a big drop.
Huge. And it led to 12 consecutive debt rating upgrades. They're now just one notch below investment grade. That's a major signal of financial stability. So connecting this to the bigger picture, these past 5 years were really about building incredibly strong financial and operational muscles, making them far more resilient.
Okay, that's a significant turnaround story, a very strong foundation built over 5 years. So it really makes you wonder then, given all that success, where did things get bumpy in FY25? Because clearly this last quarter wasn't smooth sailing.
Yeah, you're right to ask. Despite that strong foundation, FY25 definitely presented some significant hurdles. You had this combination of trying to fuel growth, keeping up very high advertising, and promotion spending like high 20s as a percentage of sales.
Wow, that is high.
It is. And trying to hit financial goals, all within a really complex market, it sort of created a perfect storm. And some hidden weaknesses started to emerge. Things like, well, maybe they didn't spot execution issues in the U.S. market quickly enough. Retailers built up too much Coty inventory. Plus, they had really tough comparisons from their huge launches in FY24, Burberry Goddess, Cosmic Kylie Jenner, Marc Jacobs Daisy Wild. Those were massive hits.
Right, hard to lap those kinds of successes year after year.
Exactly. And a major factor was this thing called retailer destocking.
Destocking.
Yeah, it just means stores were selling off the Coty inventory they already had rather than placing big new orders.
Ah, okay. So Coty's sales to the retailers dropped.
Precisely. And that really drove a very weak Q4. Coty actually expects some of that destocking to continue, though maybe at a lower level, into the first half of fiscal 26. The U.S. market, which is their biggest market by far, was a particular struggle. Get this. The overall U.S. prestige beauty market grew around 4% in FY25. But Coty's like-for-like sales, that's sales from existing stores, they actually declined mid-single digits.
Ouch. So they lost share.
Seems like it.
Yeah.
And in the U.S. mass beauty market, where the overall market dipped about 1%, Coty's like-for-like sales dropped a mid-teen percentage.
Even worse.
Much worse. And this stark underperformance in the U.S. basically drove all of their overall like-for-like sales decline in FY25. It was the main drag. And digging deeper, it also seems to have highlighted a misallocation of investment. Maybe too much focus on U.S. mass beauty, potentially at the expense of the more profitable prestige and mass fragrances. Plus, you had the broader market slowing down a bit. Prestige fragrance growth moderated. Mass cosmetics saw a sharper slowdown, maybe consumers seeking more value, some innovation fatigue, Gen Z shifting towards fragrances. And then there were other headwinds, increased in-store anti-theft measures hitting retailers in the U.S., maybe some impact from immigration policy changes, retailers just recalibrating their working capital, ongoing disruption in Asia. It was a lot.
Yeah, a confluence of factors.
It really highlights how even these big global giants can suffer from local blind spots, maybe lag a bit in adapting strategy when consumer behavior and retail dynamics shift so fast, especially in a key market like the U.S.
A good reminder that past success doesn't guarantee future agility, right?
Exactly.
Okay, that's a powerful point about those local blind spots and the need for agility. So with these challenges now clearly identified, what are they actually doing about it? It sounds like they have a pretty detailed action plan.
They absolutely do. It seems like a really multi-pronged strategy designed to, turn things around. First, significant organizational changes. They've put in a new regional structure, the idea being more agility. They've brought in new seasoned U.S. leadership, and they've even adjusted their bonus structure to better incentivize regional performance, not just overall company performance.
Makes sense. Focus on fixing the regional issues.
Right. And they say early signs are promising, like a narrowed gap in U.S. prestige fragrance sellout. So product moving off shelves faster. Then there's a big push on efficiency. The next phase of their All-In to Win program, they're targeting $130 million in annual fixed cost savings through fiscal 27. That contributes to about $200 million in combined savings, including productivity, just in fiscal 26 alone.
Wow, serious cost cutting.
Well, cost savings and efficiency. They've created a new Chief Performance and Operational Excellence Officer role to really drive this. So it's not just about cutting, it's about optimizing their whole operational DNA. Tariff mitigation is another really crucial area right now. You've got this new 15% U.S. tariff on European prestige fragrances, plus over 30% tariffs on certain Chinese components and materials.
Yeah, those tariffs add up quickly.
They do. So Coty's strategy has several parts. They proactively built up several months of U.S. inventory before the tariffs hit hard. They implemented a mid-single-digit price increase on prestige fragrances in the U.S. back in August, helps offset costs. And critically, they're actively transferring some fragrance manufacturing to the U.S., particularly for mass and entry-level prestige products, and diversifying their supply away from China for components where they can. They estimate the gross tariff headwind is about $70 million in FY26, but they think these mitigation efforts will offset maybe $15 to $20 million of that, mostly in the second half of the year. Beyond that, they hit $1 billion in e-commerce revenue in FY25. That's a big milestone. They're embedding digital teams locally now for better omni-channel execution.
Seamless online, offline experience.
That's the goal. And they're accelerating AI across the business. demand planning in the supply chain, a price chatbot for procurement, optimizing media allocation, content creation and marketing. They've even deployed over 60 robotics process automation bots for back-end tasks already.
So really leaning into tech and efficiency.
Absolutely. This whole suite of actions, it really underscores their agility, or at least their attempt to be more agile, in a turbulent environment. They're not just reacting. They seem to be truly rethinking how they operate.
That is a very comprehensive set of actions. It really seems like at the heart of Coty's strategy, and you mentioned their strong foundation over the last 5 years, are fragrances. Is that still the central focus moving forward?
Oh, absolutely. You could say they're doubling down. Fragrances already make up over 60% of their revenues and an even larger slice of their profits. And they are a major player, top 3 in the huge $50 billion prestige fragrances market. About 12% market share, right up there with giants like LVMH.
Yeah.
And they're number 1 in the $7 billion mass fragrances market in developed countries.
So clear leadership positions.
Right. And their capabilities here really set them apart. They have leading R&D, over 80 active patents, a dedicated fragrance center of excellence in Geneva. They operate one of the largest fragrance plants in the world, think 200 million units a year capacity. And they have massive global distribution, over 20,000 retail doors.
That's scale.
Exactly. And what's really exciting for them and for the industry are the structural growth drivers for fragrances right now. You're seeing new consumer groups entering the category, man. Hispanic consumers, Gen Z. That expands the base significantly. Usage is also increasing. Half of U.S. prestige fragrance users are now considered heavy users. And this fragrance wardrobe trend is real people using 3, 4, multiple scents routinely.
Yeah, I hear about that. Not just one signature scent anymore.
Right. Plus, fragrances seem to benefit from what Kelly calls treatonomics. You know, the idea that people indulge in small, mood-boosting luxuries like a nice scent during uncertain times. McKinsey even thinks fragrances will lead beauty market growth through 2030 at a mid-single-digit annual rate.
So a growing category overall.
And loyalty in this category is remarkably high. Over 70% of prestige fragrance users in the U.S. and China stick to just 1 to 3 fragrances. Mass fragrance loyalty is even higher, like 2 to 3 times higher than cosmetics loyalty in places like the U.S. and Germany.
Interesting. So once you find a scent you like.
You tend to stick with it. Their innovation pipeline looks strong, too. Last year's Burberry Goddess was the #1 female fragrance launch globally. And recent launches like Bonnes Bottled Beyond are apparently tracking above even Burberry Goddess's early success. They also have a major attack plan for the fast-growing $7 billion fragrance mist category, launching mists across more than a dozen brands. Mists are affordable, they bring in new customers, and they're highly profitable.
Like body sprays, but maybe more sophisticated.
Kind of, yeah. And potentially very lucrative. Plus, they're developing new internally created brands, like Origin, exclusively for retailers like Walmart. So yeah, this unwavering focus on fragrances, leveraging all their capabilities, it's clearly aimed at capitalizing on what looks like a structurally growing high-loyalty market.
Okay, that deep dive into fragrances really highlights their core strength. But beyond fragrances, how are their other businesses performing? And what about their broader efforts like in sustainability?
All right, good question. Skincare, they say, remains a strategic focus. Brands like Lancaster, Orveda, Philosophy. But they acknowledge that scaling skincare takes time and takes patience. So they're being, let's say, vigilant with their investment levels there, carefully managing spending.
Makes sense. It's a crowded market, too.
Very. Now, in color cosmetics, they've acknowledged the pressure, especially in the U.S. mass market. Apparently, they'd previously kind of overinvested there, maybe chasing market share. But now they're prioritizing what they call step-changing profitability for this business. Because while color cosmetics is about 20% of their sales, and it actually has good gross margins, over 60%, its contribution to operating income has been, well, modest.
So focus on making money, not just selling product.
Exactly. They are, however, trying to capitalize on current trends within cosmetics, like the booming lip subcategory. They got CoverGirl's Yummy Blur, Rimmel's Oh My Gloss, Butter Me Up. Those are getting strong consumer ratings, apparently. They're also launching multitasking beauty products, like Rimmel's Multitasker Jelly Crush, CoverGirl's Troublin Skin Enhancer Balms, things that do more than one job.
Ah, the convenience factor.
Right. And looking ahead, some potentially exciting new launches. Marc Jacobs makeup is slated for calendar year 26. A Swarovski fragrance in 27. And that's interesting because they can leverage over 2,000 Swarovski stores globally.
Built-in distribution.
Exactly. And new Marni and Itro beauty lines coming in fiscal 27. And quickly on sustainability, or ESG, They've hit some milestones. Patented an art cycling innovation for Infiniment Coty Paris. Earned a gold EcoVadis rating, puts them in the top 5% globally for sustainability. Made the CDP Supplier Engagement A-list. And launched new sustainability targets for their suppliers. So it shows this clear strategic shift. Double down on what works, fix what doesn't, prep for future growth, and keep the ESG goals in focus.
Okay, so we've seen the challenges from FY25, the really detailed strategic responses, and where they're focusing their strengths, particularly fragrances. What does all this mean for the year ahead then? What's the forward guidance telling us about Coty's trajectory for fiscal 26?
Yeah, the outlook for fiscal 26 paints a very clear roadmap, I'd say. They expect steady, sequential improvement, both in like-for-like sales and adjusted EBITDA trends throughout the year, with a strong return to growth expected in the second half.
Okay, so improvement through the year, growth later on.
Exactly. But the first half of FY26, so the next 6 months or so, will still be challenging. They expect net revenues to remain negative. That's because of that continued retailer inventory reduction, the promotional environment, and those tough comparisons from last year's big launches. Specifically, they're guiding for a like-for-like sales decline of 6% to 8% in the first quarter of 26, then improving slightly to a 3% to 5% decline in the second quarter.
Still declining, but getting better.
Right, showing that gradual improvement path. This will also mean some gross margin pressure in the first half from lower sales and the net impact of those tariffs. They expect the tariff hit to be more pronounced early on before their mitigation efforts really kick in later in the year. Adjusted EBITDA is projected to decline mid to high teens percent in Q1 and then low to mid-teens percent in Q2. Adjusted EPS, though, excluding an equity swap, they forecast at 33 to 36 cents for the full first half. That's helped by lower interest expense and a lower tax rate.
Okay.
And importantly, they project seasonally stronger free cash flow of over $350 million in that first half. And they expect their debt leverage ratio to stay stable or maybe even tick down slightly from that 3.5x level by the end of this calendar year. But then the second half of fiscal 26, that's where they expect the turnaround to really show. Net revenues are forecast to turn positive again, supported by new launches, easing comparisons. And this should lead to growth in both adjusted EBITDA and adjusted EPS in the back half of the year.
So a tale of two halves, really.
Very much so. And longer term, they remain committed to getting that debt down further in calendar 26, aiming for an investment-grade profile. And they still plan to divest their financial stake in Wella. So yeah, this forward guidance gives a really clear picture, expecting a tough first half as they clean things up, implement changes, deal with inventory, followed by, hopefully for them, a strong rebound in the second half as their strategic levers start kicking in.
Wow. What a deep dive. We've really seen Coty navigating a truly challenging, complex beauty landscape. Leaning into its core strengths, especially fragrances, seems key, while also making some very decisive strategic and operational adjustments for the future. It feels like they're reestablishing a healthier baseline for growth, with a clear path, at least in their view, to returning to multi-year growth and expanding margins, driven by those blockbuster launches and innovation.
Absolutely. And ultimately, for you, the listener, maybe it raises an important question to ponder. In an industry so deeply tied to, constantly shifting consumer sentiment, fleeting trends, global retail dynamics, how quickly can a company, even a strong one like Coty with robust core capabilities, really pivot its massive operations, pivot to meet these evolving demands and still deliver on ambitious financial goals? It's really a testament to just how complex and frankly fascinating the global beauty market truly is.